Good day. Welcome to our latest Fixed Income Market Outlook podcast. My name is Chang Wai Ming, Head of Fixed Income Strategy at RHB Bank, Economics and Market Strategy. For today's podcast, we will be sharing the latest updates in Fixed Income Market Outlook. Given that the global monetary policy landscape is expected to remain lower for longer, we prefer longer-dated ringgit bonds. We expect demand for safe haven US Treasuries to remain supported following the January US FOMC meeting decision, with officials maintaining the key policy rate unchanged at near zero levels. Based on the dot plot projections released in December 2020, key policy rates are expected to stay near zero till end 2023. At the concluded January FOMC meeting, Jerome Powell assured that it is still early to discuss about withdrawing policy support, reiterating that asset purchases will be capped at current pace, 120 billion monthly purchases comprising of 80 billion worth of US Treasuries and 40 billion worth of mortgage-backed securities. The macro landscape for the US economy remains challenging, with the US labour market still weak given the stricter movement controls following the resurgence of COVID-19 cases in the US. The latest December non-farm payroll data showed decline in job numbers by 140,000 with unemployment levels at 6.7%. Meanwhile, US jobless claims have stayed elevated, with the latest level at 847,000. On the home front, we prefer the longer-dated ringgit government and corporate bonds sukuk sector. From a regional perspective, the wide spread on 10-year versus 3-year MGS at above 80 basis points suggests good investment entry on the long ends. We opine there is room for further yield tightening for ringgit bonds amid downside risk to growth from the resurgence of COVID-19 cases in the country, and we expect the monetary policy landscape to remain accommodative. The ringgit bond market continues to stay resilient. In 2020, the ringgit bond market continued to garner positive inflows with total accumulated net foreign inflows around 18.3 billion ringgit. Total foreign ownership of ringgit government bond now stands at 24% as at end December 2020. We expect foreign ownership of ringgit bonds to remain intact in 2021 as real yields from investing in ringgit bonds are still attractive. We expect the extension of SRR compliance by Bank Negara Malaysia until December 2022 at the January MPC meeting to provide further positive catalysts for MGS and MGII. We recommend exposure to longer dated MGS MGII, with investors extending out the curve given the better yield pickup. Banks are likely to extend duration given the better yield pickup in longer dated MGS MGII. We prefer the 15-year MGS space given the still wide 15-year versus 10-year spread of above 60 basis points. Demand for MGS MGI remains healthy after the recent 10-year MGS auctions printed a steady BTC ratio at 1.99 times. Real yields from investing in ringgit bonds are still attractive. 10-year MGS still provides a good real yield above 4%. 10-year MGS real yields continue to stay above 4%, with the latest December inflation print at negative 1.4% year-on-year. Strong institutional support at the longer-dated sector to augur well for ringgit bonds. In longer-dated corporate sukuk, we prefer the 15-year sector and strong investment-grade bonds. In the 15-year AAA corporate sukuk sector, credit spreads are around 50 basis points above 15-year MGII, which is deemed attractive. The current spread on 15-year AAA versus 15-year MGII is compelling versus the 2-year historical spread average level of around 32 basis points. The current low interest rate environment offers a good window for issuers seeking to lock in on lower borrowing costs, especially in the longer dated sector. Total corporate bond issuances in 2020 have stayed healthy, with combined issuances worth 104.5 billion, despite a challenging business environment from impact of the COVID-19 pandemic. The current conducive funding window also provides a good opportunity for issuers to tap the perpetual sector as an avenue to improve balance sheet strength as well as locking in on lower borrowing costs. In summary, we remain constructive on ringgit bonds and we prefer the longer dated sector both in the government and corporate bonds and sukuk, given the additional yield pickup. We expect the global monetary policy landscape to remain lower for longer to augur well for the ringgit bond market, as real yields are still compelling for investors. Thank you, and please continue to stay tuned to your upcoming podcast series in the coming months as we continue to share more updates on fixed income views. We hope our key takeaways mentions will help you navigate better in 2021 from both investment and funding perspectives.